In this video, I'm going to teach you about a newer investment concept called GP stakes. GP in this context means general partner. I'll walk you through and explain what investing in GP stakes is and what it means, and the types of income you could earn as an investor in a GP stakes deal. This is probably not something a lot of you have heard about. It may be a completely new concept to you. I think it gets on kind of the more complicated end of investing, particularly when you're talking about investing in alternative assets. And when I say alternative assets, I mean broadly funds, syndications, things that aren't just kind of the run-of-the-mill stocks or bonds that everybody knows about. These are really investments where only a certain set of people actually have access to these investments. And if you haven't watched my investment hurdles video, I'll link to it below because I think it's very important you understand the different investment hurdles based on how much net worth you have and the types of investments that are typically available to you at each hurdle as you build your net worth over time. In this case, for the most part, to invest in GP stakes, you need to be what's called a qualified purchaser. If you don't know what a qualified purchaser is or who can be, considered a qualified purchaser, check out that investment hurdles video so that you can have a better understanding of what you need to do to reach that hurdle. So if you are a qualified purchaser or you think you will be soon, this is a specific type of investment. I say it's newer because it's really only been around, I think, for a decade or so. It's certainly newer to me. It's not something that I was ever taught about, or, it's certainly not something a lot of people know about. So after you watch this video, you're already going to be ahead of the game by understanding what GP stakes investing is. I'm very excited about this type of investment. I have a couple of these deals that I'm invested in. And I think it's exciting to get exposure to a different side of the investment itself and the different types of income that you can earn from that investment. Also, I'll explain to you why this is the case, but it lets you really invest the same way that the biggest management companies out there investing. So think Blackstone or Carlyle, you can actually kind of co-invest with them through their GP section of the fund. So I think that's very exciting. It's certainly not something that I ever thought that I would be able to do, but it's really exciting to kind of get to see that side of the deal and be invested along with the best in the business. So let's go ahead and dive into what GP stakes are. So to start with, you have to understand what a typical fund structure is. So, this is a very basic concept here. There can be situations where a fund is more complicated. There might be more entities involved, but this is kind of the most basic concept for how a typical fund is set up. So here you have your fund manager or general partner or management company or sponsor. They can be called a lot of different things, but basically that is the team who is putting the deal together. They're going to be the ones who fundraises to get investors to invest in the deal and put their money into this. They're going to be the ones that manage the investment. So they're going to decide what the fund buys, when it buys, what it buys, and they're going to decide what exactly the fund's going to specialize in. So if it's real estate, the fund will, decide, will it be multifamily real estate properties? So the fund manager will go out there and identify potential multifamily properties that the fund should buy, and they'll make the decision on when to buy, how much to pay, anything that relates to managing the fund itself. So not only acquiring the investments, it can be real estate, it can be, private equity where it's going out and buying stakes in companies. It can be a lot of different types of assets. But for our purposes, the fund manager is going to decide everything. So you as the investor and the limited partner, you're going to typically come in this way. And this means you're giving your money over to the fund manager and you're going to hand over the reins and let them make the decisions on investing that money. So they may operate if it's real estate, they'll be involved in operating the real estate properties, whether they do that themselves through their own management company or, hire some third-party manager. They're the ones making the day-to-day decisions. And the fund manager is also going to be the one who makes the decisions on when to sell the property. So if it's real estate, if it's, underlying portfolio companies in a PE fund, then the fund manager will make the decision on when to exit those properties themselves. So in a typical structure, it doesn't really matter what type of fund it is. This is, relevant to all types of funds for the most part. So we're going to come in as investors in the limited partner side of the structure. So we come in, limited partners typically comprise a large portion of the fund. It's probably like they own 90% of the fund, in some cases more. And the general partner might own 10% or, interest or less. And, everything is pulled here at the fund level. So what's different about a GP stake structure is that instead of coming in here as a limited partner, we're actually going to come in here. And so this is why it's really exciting, is that the types of income that these people in these different sections of the structure earn is very different, as well as the types of risk you're exposed to and potential upside that you could get from the deal. But it's very different depending on which side of the structure you're coming in. And so what's different about a GP stake structure is instead of being a limited partner investor in the fund, you're actually a limited partner investor in the fund manager or the general partner. It's called GP stakes because you're invested indirectly in a stake of the general partner. So it's a stake in the GP itself. So that's basically all you need to understand as far as why this is different. I'll walk you through why it's different as far as types of income that these will earn. But basically, you need to understand that you're coming in a completely different side of the structure itself. And you're going to earn different types of income. You're going to be exposed to different types of risk. And the upside potential from the investment itself will be very different because you're coming in a different side of the structure. So even though these two are coming into the fund and own an ownership interest in the fund itself, there's a lot of different types of incomes that the general partner will get in addition to their very small ownership interest in the fund. So let's go ahead and walk through what are the types of income that you could get as an investor in a GP stakes. So general partners of a fund, they get a couple of different types of returns. There's really three key types of income that a general partner can get from an investment. So they get management fees. So those are fees basically that the general partner gets because they are managing the investments. So whatever type of fund it is, whether it's private equity, real estate, infrastructure, anything out there, they're managing the investments, and what that management might involve is very different depending on the type of fund you have here, but they're going to get management fees. And typically those management fees are a percentage of the assets under management. So, if you think of a typical like financial advisor, you pay them, maybe 0.5% to manage money in a brokerage account. Here it's different because you're basically paying the fund manager to manage your money, and it's very different in how they're managing that money, but you're still similar to like a financial advisor who manages a stock portfolio. Fund manager manages your investments here, and they're going to get a management fee. So if the size of the fund is, $1 million, 10 million, 100 million, it doesn't matter. They typically get 2% of assets under management. Sometimes you can get a lower management fee, but pretty industry standard is 2%. If you're a bigger investor, if you're coming in like you're an institutional investor, that percentage will probably go down because you have more kind of bargaining power. Or if you're coming in kind of as a collective pool with others, then sometimes you can get that management fee down. But usually it starts at 2% of assets under management. So assets under management are whatever amount of money investors are putting into this fund. And that's one type of income that the general partner gets. So that is a type of income that you will have access to as an investor in GP stakes funds. So whereas before you're the limited partner and you're basically paying that management fee. So you're paying the general partner to manage your money. Here, you're actually receiving that management fee or a very small piece of it as an investor in the general partner itself. So this is what I mean when I say GP stakes open up the ability to get access to different types of income. And earning management fees is a very different type of income stream than you would typically get as, any other investor. So why do I like it? I like it because it gives you some downside protection. It's more predictable. So whereas, a limited partner, you get basically, if it's a type of investment like real estate that pays distributions throughout the hold period and cash flows, then you'll get distributions from the income that the properties generate. But, you'll also get, if it's PE or real estate, you'll get, a big payout when they go to sell the property at the end of, wherever they decide to exit. So those are really the two types of distributions that you're going to get as a limited partner. And those are all based on how well the fund performs. So if, in most cases, the fund is going to make money, but the distributions or the money that you get from your investment is really just based on how well that the asset performs or assets perform. Whereas here, you're getting management fees regardless of how the assets perform. So even if the fund doesn't perform very well, and, for some reason, you can even have a situation where you're losing investor money and not doing well, you're still getting management fees as a general partner, that you're still paying those management fees. It's just 2% of the assets that are under management. So as an investor who's entitled to have a piece of those management fees, you're going to have more predictable, steady income because you're getting paid those management fees throughout the duration of the investment, regardless of how the investment does. So when you think about a time where the real estate market or just the market in general, suffers a downturn, management fees can kind of be a good bit of protection against that because you're still getting your 2% of the assets that the fund is managing. So I like that about management fees. It's just a different type of income than, any other type of investment really is going to give you. And it's kind of a more steady, predictable type of income. The one thing I don't like about management fees and kind of GP stakes investments overall is that is ordinary income from a tax standpoint. So it's not necessarily taxed at a great rate because management fees are ordinary income. They're not subject to, capital gains treatment here. So that's the one downside here. But hopefully, the returns you're getting from those management fees and the other three types of income, the two other types that I'll discuss, is enough to compensate for the fact that you are kind of paying that at an inefficient tax rate. So management fees is the first type of income you'll get. The second is carried interest. So you may have heard of carried interest before. This has kind of been in the news a lot because a lot of lawmakers are coming after this. They don't like how some of the wealthiest people or fund managers who pay, rates of tax very low compared to those of us who have W-2 salary jobs where you're paying at a much higher rate on your income. Carried interest can typically get capital gains treatment. So that's why you've got, some of the wealthiest people in the world, like Warren Buffett, for example, says he pays a lower effective tax rate than his secretary. This is a lot because, a lot of his money could be in the form of carried interest. So carried interest is basically a profit share paid to the general partner that is based on the underlying performance of the investments. So the industry standard is that typically 20% of profits above whatever set threshold there is. So let's say it's real estate investments and the real estate fund just performs phenomenally. It makes huge returns throughout the hold period. And then when they go to sell the properties at the back end, there's a huge gain in the, what investors earn as far as the increase in the value of the property over time. So once investors are paid back, whatever the agreed threshold is, it might be the money you put in, it might be the money you put in plus 10%, whatever it is, that once that hurdle is met, that's set by the fund and the fund manager, then the general partner is getting 20% of the profits above that. So that can be an astronomical return for the general partner. So you as a limited partner, you're getting, 80% of those returns once you reach that hurdle because you're the limited partner. But the GP also, does get that 20%. So that, of course, incentivizes the general partner to manage the investments in the fund in a way that maximizes limited partner returns. So we like it because everyone has, aligned incentives financially. But that's just another type of income that the general partner gets that the limited partner won't get because the limited partner just gets their returns when the investments are sold. But the general partner is going to actually be able to come in and get an extra kind of stake in that by getting their 20% carried interest. Carried interest is usually capital gains treatment if it's, if it's held for 3 years, and typically a fund will set it up so that always is the case. So typically you can think of carried interest as being capital gains. So that's just that's good from a tax standpoint in the sense that it's not taxed as ordinary income. It's more favorable than the management fees. But this is a type of income that is different from what you would get as a limited partner. And it also has a bit more favorable tax treatment here. So that's just another type of income that is great about this. And of course, you as an investor in the GP side of the fund, you will get a piece of that carried interest as well. So this last type of income I'm going to talk about, this is the one type that is also similar to what you get as the limited partner. So everybody invested in the fund is going to get their share of distributions from the fund and their share of gains when the underlying investments are sold. So if you go back to this slide, everybody owns an interest in the fund. So the general partner, let's say they might own like 10%. They're not going to own a large piece of the fund, but they do own some piece. So they do get their share of distributions from the investments themselves. So similar to limited partners, you do get your share of distributions throughout the duration of the investment. So if it's real estate, that can be distributions coming from the underlying investments. Depending on the structure of a PE investment, you might have distributions coming from that. That's not as typical, but most of that income is probably going to be capital gains, because a lot of it is going to be gains from the sale of the assets themselves, after the hold period. But it can be ordinary income in some cases, but most of that income is going to be capital gains for the most part. So more favorable tax treatment there. And this just allows you to get just your returns from the investment same as if you were a limited partner. The one thing I will say is that you don't get as much of a piece of the pie as far as returns. And that's because the limited partner, section of the fund, they own usually a lot more of the fund, like 90% or so. So they're getting the bulk lion's share of, returns distributed go that way. Whereas the general partner only has a small stake. And so the amount of returns you get, the percentage of your share of those returns is lower. So you could say, the upside potential for an investment is higher for limited partners because they get a bigger share of any returns. However, that is, maybe viewed as riskier, whereas the general partner share is some of the risk is mitigated by the payment of the management fees because those are paid regardless of how the fund performs. So I think that's something important to keep in mind, that, I wouldn't want 100% of my alternative investments allocated to these GP stakes because there is, I do think, some limit on upside earning potential because of the fact that, limited partners are really the ones that have, most of their money at risk. And the general partner will have some money in the deal. But for the most part, it's limited partners that are putting their money at risk, and they have the most upside potential as far as what they can earn from the fund usually. So, it is good to also have some, good number of investments where you're coming in as a limited partner and just the limited partner side of the fund. But I do think it's nice to have this option to buy, come in as a GP, a share of the GP, because it's just different. It diversifies your investments, gives you access to different sides of the deals, and gives you access to much different types of income that you can earn. So just to kind of recap there, as far as what a general partner is and what you're doing is you're basically buying, if you come in and invest as a GP stakes fund, you're buying a minority interest in the management company. So, going back to this slide, you're buying a minority interest in this general partner. You're not typically going to come in and buy like a controlling piece of that. It's typically going to be, a minority interest of that general partner or fund manager that exists with respect to the deal itself. So, again, this isn't something that a lot of people are familiar with. It's something that is, I think newer to a lot of people, particularly those of us that are individual investors and are, investing through like family offices or really large kind of institutional investors. But I think, when I first was looking at this years ago and deciding if these types of investments made sense for me and, trying to understand just what the heck they were, I think one of the questions I had is that, okay, so Blackstone and Carlyle go out there and they, or any fund manager goes out there and puts this deal together. They're making good money from the investment through, the income they get as the general partner. Why would they ever sell their interest? Like, why would Blackstone want to sell a share of their, fund management company in a deal? So that, I think it is a question that everyone has when they first look at this. But I think when you really understand the industry as far as fund managers, how they operate and these management companies, then it kind of becomes a little bit more clear as far as, why there are these opportunities to buy a stake in the a GP stake in the structure itself. So there's a couple of reasons why, a fund manager might sell a piece of its, a piece of the GP itself. And I think the biggest, most common one that we think about here is that fund managers and management companies, they need liquidity. So they might want to go out and start the next deal. They might want to go out and somehow diversify themselves. They don't want too much of their money tied up in this one fund or this one, investment. So management companies need liquidity too. And I think it's important to understand that when you're investing, it is always, during due diligence of deciding a sponsor or fund manager you want to invest with, you want to see the general partner of any fund put their own money in there. You want to see that they have skin in the game, that, they're risking their own money because they believe that this is a good, investment to make. And you want their kind of incentive, you want everybody aligned with the same financial motivation and incentives here. So general partners might have to put a bunch of money into the fund to get it set up to satisfy, LPs. Hey, I'm putting a lot of my own money in here. And then they might want to, take cash out and go start their next fund or, start something different or somehow diversify. So that's not, that uncommon, that they need liquidity and want liquidity. So that's a big part of why this whole GP stakes investing, concept exists, is that management companies and fund managers, they need liquidity as well. So that's why we have the opportunity to invest in things like this. And again, I think it's great to be able to get exposure to something very different here. And, there's a lot that I like about it. As I talked about, I like, the diversity that you get here, the different types of income that you get access to, some of the downside protections. The one thing I don't like is some of the tax treatment on some of the different types of income you get. And the fact that you're, in a lot of cases, not going to have as high return potential as some of the limited partners. So just always remember, diversity is good in the sense that not only do you want to diversify the different types of investments you're making, you want an assets you're investing in. It's also good to diversify how you're investing in those. So if you can come in a different side of the structure, good to maybe have a few of those deals in place. But again, a lot of these deals, at least the really good quality GP stakes investments that I've seen, are limited to qualified purchasers. So make sure you understand what a qualified purchaser is and when you can, get access to those types of deals. But definitely something you need to know about. This is a very kind of new concept. Not a lot of people out there are talking about it or know about it. So now you kind of know about one of the newer, most exciting, I think, investment alternatives out there. So hopefully you found this video helpful. If you did, please like and subscribe to our channel.